Science Day to everybody out there. I hope your day goes great, whatever your plans are. And again, thank you for listening this morning on my Affordable Care Act update. Really, plan is to be a 20 to 30,000 foot level overview of what's going on out there and so forth. So on my agenda today, I want to talk a little bit about the individual mandate, large employer penalty, and the affordability update. The IRS notifications out there of the employer shared responsibility payments, also called ESRP notices. What's going on with the ACA community rated coverage for small employers, the notification of individual subsidy, Cadillac tax, medical device tax, and annual fee on health insurance providers delay, ACA reporting. Again, talk about some recent updates on the qualified small employer health reimbursement arrangement. And I just want to touch base on health savings accounts. That might be a little bit out ACA guidelines, but I always like to touch base on those. So, individual mandate. As we all know, it's still in effect for 2018. The repeal of the individual mandate was really, the tax is going away in 2019. And because of that, we hear, not from all employers, but we hear, does this have anything to do with the employer mandate? And actually, it does not. What's going away is the tax on individuals if they do not buy health insurance in 2019. But those who do, if they go to the marketplace and if they qualify for subsidies, those subsidies are what trigger the penalties in the employer mandate. Those are not going away. So that's why it has no effect on the employer mandate. But the minimal effect employers could see because it's going away is you might have employees again just voluntarily drop their coverage in 2019 since they'll no longer have that tax or penalty as we call it. So that could happen. You could have employees drop off your plans, but if you offer a plan that's not affordable, it doesn't make minimum value, and an employee gets a subsidy through the marketplace, that will still result in a penalty back to the employer. So that's kind of why I want to talk about the individual mandate. So it really has no effect at all on the employer mandate. Speaking of the employer mandate, just give you an update on the large employer penalty and affordability, where you have to be on that. So the employer penalty, as you can see here from 2015, it's been indexed off the original penalty that was designed to be effective in 2014, which was delayed. So 2015, you can see where the penalties are at. The first penalty, the 2000 penalty, that's what they call the A penalty. That's if you don't offer coverage at all or don't offer it to more than, well, for 15, 70% of your employees, and then for 16 and beyond, 95% of your eligible employees. So those are and then the B penalty is the $3,000 penalty. That's if you do offer coverage, but it's not affordable or it doesn't meet minimum value. We believe most plans that are being offered meet minimum value, but then sometimes those plans offered are unaffordable. So you can see that. So for 2017, the penalty for the year we just had is $2,260, $3,390, and then for 2018 it goes up to $2,320 and $3,480. I'll be talking a little bit about 2015, the penalties of the $2,080 and the $3,120 shortly after this slide. And then affordability update as indexed off the 9.5% that a lot of people talk about. What is that? That 9.5% or the indexed amounts that you see up here for 15 through 18, that's the percent that you have to apply to figure out is the coverage that I'm offering to my employees, my lowest cost coverage, is that affordable to them? So as you can see, every year they've gone up a little bit, doesn't really change that much, but if the coverage cost as indexed more than 9.5%, then the member's income, then it's going to be unaffordable. The interesting thing here is it's gone up every year, 2015, 16, 17, and then all of a sudden in 2018, the percent goes back down to 9.56. So that's going to drive up the cost a little bit for the affordability, just a touch for 2018 that employees have to comply with versus 2017. And then what I did is on the bottom, I put up what the federal poverty level safe harbor cost would be if the cost of the health insurance for your employees for the lowest cost plan that is available to them is equal to or lower than these amounts. Your plan would meet that federal poverty level safe harbor for one of the affordability guidelines. There's 3 guidelines out there. There's the federal poverty level, then there's the rate of pay, and then there's the W-2. And you'd have to obviously apply these percentages to whatever your lowest cost plan is you offer to figure out if it's affordable for your employees. So you can see that just moving from 2017, because from 97.38 monthly, it moved down to 96.71 because of the drop. And even though the federal poverty level went up, what is that, $80, because that percent went from 9.69 to 9.56, you'd have to, if you're using that federal poverty level as your safe harbor, you'd have to lower the cost, the employee cost, down to 96.71 for 2018. So, quick update on that. Next, excuse me a second. In regards to the letters that are going out, there are the IRS employer shared responsibility notifications have been going out. We've had ourselves a couple clients here that have received the letter and stepped in for them and helped them on it. But what that letter is, that's a letter notifying you now that you are getting a penalty. And so far, all the letters that we have seen have been penalties for all the way back to 2015. This is where we hope everybody kept good records. That letter, again, this is a high-level overview of it, but it's going to have 7 pages of information you must read. Read every page, go through it, look and see what the IRS is saying and why you're getting the penalty and so forth. One item you must note, and please don't forget, is the response date. You must respond by that date. And unfortunately, with things how they go with our government, we've been hearing some people saying, the letter was dated January 1st, let's say. They get it January 15th, and they have to respond 30 days from the January 1st date, not the date that you're getting it. So you really got to watch the date that they're saying that you have to respond. And when you look at your letter, it's from the Department of Treasury. You're going to see in the upper right-hand corner a column where it starts out with tax year, letter date, employer ID number. Bottom is response date, and that's what you really, really have to look at. And then obviously another item you won't miss is proposed penalty amount, which is highlighted bold right after Dear Employer. So those are the 2 things that will stand out and you will take notice of. So the letter you're getting, though, is not a formal notice and demand for payment. What this letter is used for is to promote and assess the penalties that the IRS is applying. You're going to see a brief explanation of the pay or play provisions. You're going to have a table itemizing the proposed penalty month by month and whether it's an A penalty or a B penalty. You're going to get an employer shared responsibility form, 14-764. You're also, on that form, you're going to have a list of full-time employees that receive subsidized marketplace coverage for each month that they received it for the year that the penalty's for, which should be for 2015. And then you're also going to have in that the action you should take if you agree or disagree with the actions the IRS will take, and the actions the IRS will take if no timely response. So that goes back to the response date. That's very important. The form 14-764 that's included, real simple. You're going to have a form that's going to be what you're going to want to respond with, and it's fairly straightforward. you agree that you should be getting a penalty, you'll notice on there there's a I consent to the assessment box, and indicate payment method and make payment. Or if you check the I disagree box and comply with the information requested, if you disagree with this proposed ESRP section on page 2 of letter. So those are the two things you'll do. So far, all our clients have checked the box where I disagree. And with that, depending on the circumstances, you may not want to go this alone. You can get help from your agent. Third party, if you have a third party that's doing these forms for you, such as your payroll vendor or a third party, there's many third parties that have popped up due to the ACA that provide the 1095s that are being submitted right now to the IRS. You can go back to them, or if it's legal, this is a good situation. You might get an attorney involved to respond. But even if you decide to bring in legal, make sure a response is made by date indicated. You can respond without legal, and you can give a brief explanation as to why you're responding. If you do that, and then you want to get legal involved, obviously, you're good to go as long as you make that initial response if you're contesting the penalty. And I even heard of an employer. There's phone numbers on there you can call. They call the IRS contact, and over the phone, they got the employer shared responsibility payment rescinded just with a call. So it could be as simple as that, or it could be as difficult as wanting to get legal involved, depending on each individual's situation. So, and again, you only get that if you have a penalty coming your way. And again, I've only seen them so far going back to 2015. Next up to date is the ACA Small Employer Community Rated. As of today's date, there has been no mention of this can being kicked down the road again. As we know, small employers out there can still stay on what we call transitional plans, plans that were in effect prior to the ACA coming into play, when employers are originally supposed to be kicked to ACA community rated plans, which was back in 2014. But at this date, small employer plans will move to ACA small employer plans, starting with renewals January 1st of 2019. Obviously, we have 10.5 months left yet to have that kicked down the road again. But as of this point, there's nothing from the feds on what they're going to do with the ACA plans for 2019. And as of this date, there's been no carrier announcement yet of early renewals. Remember back in 2014, we had everybody who was going to be adversely affected with the higher rates due to these plans move their renewal up to December of 2013 and so forth. So that, no announcement there yet if that's going to happen. I'm sure as we get deeper into the year, if it looks like the ACA plans are going to take effect for all small employers starting in 2019, we'll probably get some carriers announcing what they're going to do and so forth on that. The good news for most is we're seeing now after, we got 4 or 5 years now under our belt of ACA small employer plans, that huge gap that we saw back in 2014 is not so great anymore. We don't want anybody's rates to have to go up if they're forced to an ACA small employer plan, but they weren't those. We don't see those 50, 60, 70% increases like we were back then. Actually, we've been recommended some small employers to move to small employer plans because of the rating differences are not so great anymore, and so forth. So hopefully it's positive if it happens. Also, you can still receive out there a lot of these went out a couple of years ago, the Section 1411 certifications. These are certifications to you that an individual did go to a marketplace subsidy and qualify a marketplace and qualify for a subsidy. So, if you receive these notices, nothing's really changed on them. If you're going to appeal it, you have 90 days to appeal that subsidy. And again, this slide didn't change much from my last ACA webinar. A lot of people might say, well, if I appeal this, my employee might not get a subsidy that they're using to afford their individual health insurance they bought. That is true, but eventually that employee is going to have to pay that back. So it might be in the best interest to appeal that so that that doesn't happen, because right now what that employee is paying, it's going to be a lump sum they're going to try to get back from them, and that could hurt them more than not having the subsidy at all today. And the IRS, not the marketplace, determines if employers are due penalties. And these would be the ESRP notifications that some of you may or may have gotten today. That's where the penalties come from. So hopefully when you get these letters, you do appeal them if you feel they are in error. So that might preclude you from having to deal with market or the employer shared responsibility payment letters that are going out now in the future. So short-term spending bill delay. Back on January 22nd, President Trump signed H.R. 195. That was the short-term fix on the budget delay. So out of that, what came about is it did extend the Cadillac tax. Again, now it's out to 2022. So we've got another couple of years on that. It was originally going to take place in 2020, so it's been delayed another 2 years. And, no new, any updates on the limits. Whatever limits were set back in 2010 when this, believe it or not, we've been, the ACA was passed, and we've been dealing with it for 8 years and working through it. Whatever limits back then have not been updated or indexed. There's a lot of work behind scenes still in D.C. that many feel this tax is just going to go away altogether. But at least now we don't have to worry about it until 22 until we hear if it is going away and so forth. The other couple areas of the short-term spending bill that was passed addressed was the moratorium on the medical device tax. So it's extended for 2018 and 19. So that helps us a little bit. If they're medical device people, have to pay taxes on the products they make, such as hip joints, knee joints, and all those things. Obviously the cost of care is going to go up because that has to be added into the cost of billing from having those procedures and so forth, albeit that might be a very small percent, but it is there. The other piece that was part of this that's going to go away is the health insurance provider fee. That's been out there since the start of the tax, and in 2017, there's a pass on that year. So health insurers did not have to pay the tax in 2017. It was back for 2018, and it's been suspended again for 2019. That's actually a big piece that's going to be quite helpful, because what we saw for the years 16 and 15, we're seeing that fee plus the other fees that were part of the ACA that were being added to your renewals. We're seeing those in the 2.5% to 3-4% range. And then we obviously didn't have that in 2017, and then back for 2018, most of the carriers we saw, the renewals included that fee because they have to pay it this year again, and that fee was anywhere from, on what we're seeing, 2.5% to 3% of your renewal. So that's a lot. So that fee again, although it's here for 18, is going to go away for 19, which is anytime we can get rid of fees, that's a good thing. ACA Reporting, which hopefully most of you have completed. If not, I'm sure you're working on to complete right now. The 2017 1095-C filing dates to your employee, have to have them to them by March 2nd of this year. Your 2017 1094-C and 1095-C filing dates to the IRS are February 28th. So although you got a couple extra days to give those 1095-Cs to your employee, obviously you need to get those to the IRS by the 28th if you're using paper, and if you're using electronic, you have until April 2nd to get those forms to the IRS. And the break point on paper and electronic, everybody, if they want to, can file it electronically. But typically, to do that, you really need a third party to be handling your 1095-Cs. You know, a third party program that popped up out of the ACA rules that are doing these filings, and there's been many of them, and you know, we've kind of narrowed down to a couple selections we've been referring our clients to that have worked well. They do it, your payroll providers do it, and so forth. But if you're using paper, or if you have to send those in. So if you have more than 250 1095-C that you're submitting, you must do them electronically. And in my statement here, I said per tax ID number. And the reason why I say that is you could be a control group or part of an affiliated service group, and you could have one of your entities that you have as part of your control group could have 250 or more 1095-Cs for that group's tax ID number. They have to file electronically. But you could have another entity in your controlled or affiliated service group that has 45 members. And actually, you could submit those by paper if you wanted to. So it just depends on how you're set up on submitting those. Most employers, if they have electronic submissions for one of their entities, they typically do it for all their entities because they have one service handling that for them. But that's what it says. And if you have to do it electronically, there is special requirements that you have to have set up to be able to do that with the IRS. And although I'm not a tech guy, I've heard that's pretty costly to get that set up. So most people have hired a service to do that for them and so forth. I want to touch base on the qualified small employer health reimbursement account. Now, this is for small employers, those employers with less than 50 employees. There were some updates last quarter that came out, and I'll be honest before I go through these provisions. Personally, if you have group insurance now that you're providing to your employees, you're just really not a fan of these. And when you look at the complexity of it, most people probably, small employers that want to provide benefits to their employees but can't do it through a group plan, take a close look at this because there's a lot of complexities and a lot of things to deal with and so forth. But important provisions that were confirmed last quarter: employers cannot have a group plan in place. So if you want to set up what we call a QSEHRA, I don't know what's easier to say, the acronym or the actual long word, but you cannot have a group plan in place. And the QSEHRA must be operated on a uniform and consistent basis for all eligible employees. And what they mean by that is if you're going to give, if you set up at $300 a month per employee, it's for all employees. Or if you're going to set up on a percent of their actual insurance costs, it's got to be the same percent for all employees. Here's the big kicker for employers, where eligible employees cannot be allowed to waive coverage. So if you have a group plan, a true group plan out there, and you know that you have employees that come into you and say, well, I don't need the coverage because I have it someplace else, spouse, partner, cover on my parents' plan, they can waive that group coverage, and then obviously what your payment is that you make for that group coverage is not a cost to you, and those employees waive the coverage and so forth. If you have a QE, qualified small employer, HRA, employees cannot waive coverage. If you tell your eligible employees that everybody's going to get $200 a month to use to pay for insurance premiums or medical costs, and you have 20 employees, all 20 employees get that. You can't, an employee can't come in to you and say, well, I don't need this because I have coverage elsewhere and so forth. Plus, if the small employer is also part of a controlled or affiliated service group, which, you know, if you're concerned about that, you're not sure if you are in a controlled or affiliated service group, you can look at IRS code 414. Each employer in the group must provide qualified small employer HRH, all eligible employees on the same terms. So if you own 2 small businesses and they don't add up to more than 50 employees, and you want to provide benefits to one of your businesses but not the other, you can't do it through a qualified small employer HRA. You have to do that through a group plan to one and not the other and so forth. So there are some limitations there. Plus, employees must show proof that they have minimal essential coverage to the employer prior to reimbursement. And this can be done by documentation such as proof of coverage, ID cards from the other carrier, or you can have employees sign attestations and so forth to state that they have coverage when it was effective, when it's not coverage. And again, this is just high level, and I try to pick out the things that you really need to be concerned about. There's other employer notices that go along with this and so forth that you need to be concerned of if you hear of these and they sound like a good plan and so forth. Sometimes they're not always going to be the best. And then I always like to throw in, just what's going on with health savings accounts. We see that health savings accounts in our market are rapidly growing. Some of our clients now have these as a sole offering, but most of our clients are adding these as a secondary or third offering to get employees educated on them and moving forward on these and so forth. As always, health savings account money that people are willing to put away into their accounts goes in tax-free, can grow tax-free, and money can be withdrawn tax-free if it's used for obviously qualified expenses. In 2018, the minimum deductible is now at $1,350, went up $50, and it went to $2,750. That's the minimum deductible that you can have. You have to pay all the costs under that first before plan benefits kick in to be eligible to contribute to a health savings account. These plans can have no office or drug co-pays without satisfying the deductible first. The only exception for first dollar coverage is ACA preventive care can be covered 100%. That's the requirement through the ACA. That can be paid 100%. All other diagnostic tests, visits to the doctor must be deductible first. And the 2018 maximum out-of-pocket any one of these plans can have is $6,650 for single, $13,300 for family. And then the contribution levels, I'll include 17 and 18, are as such. So for 17, individuals can put $3,400 into their HSA. Families can do the $6,750. And the reason why I include 17 is if you want to put more money, if you have an HSA set up already for 2017, and you want to contribute more money up to that max, you can do that. You can still do that in 2018 up until the tax filing date for our 2017 taxes, which I believe is April 2nd. I'm sorry, not April 2nd. April, I think it's not the 15th. It's a couple days. I think it's the 17th this year. But so you can still make contributions for the 2017 tax year, even though it's 18 if you want to reduce your income for that year. And then the 2018 amounts have been increased. The If you have single coverage, you can put $3,450 in your HSA, and if you have family coverage, you can put $6,900. And these amounts are what you can put in, and if your employer contributes, if the employer contributes as well, this is a total amount. So for all contributions, they cannot be more than these amounts here. And if you are age 55 and over, those can contribute an extra $1,000 catch-up above the amounts above. And if there are two members that are eligible to contribute, and they're both 55, they can both members that, myself, I'm over 55, I can contribute that extra $1,000. My spouse is over 55, she can contribute that extra $1,000. But for both of us to contribute the extra $1,000, one of us needs to set up an HSA in his or her name. So that's how that works. Any bank should be able to help you through that if you have any questions on it. But so that for people over 55, that allows them, if they have a family plan, to contribute $8,900 if they have the means to do that for 2018. So for that, I just want to know if anybody has typed in any questions out there. I'll go through answering those and do my best to get those for you.
Okay, great. Looks like we have a question that was asked. The information in the letters can be incorrect because the employees stated incorrect information when they went out to the marketplace, right?
That is correct. Yeah, that's very correct. If the employee used incorrect information and got a subsidy, then then you obviously, that's where you would check, I can test this, and then you would send it back with your statement that this is incorrect and why.
So it looks like that is the only question we've gotten so far. I will leave this slide up, and we'll leave the webinar up for just another minute or so, just in case we get another question coming through. If you find that as you're reviewing information that Pat went through today, that you have questions, please feel free to reach out to him. I have his phone number and his email address there, and you are welcome to reach out to him. And if there's nothing else, we'll go ahead and end the webinar and say thank you to all of you for joining us.